Live. Hey guys and gals, just having a sip of my diet, Canada Dry Ginger Ale. I'm recovering well. I shouldn't cough as much tonight, but I can't promise you that I won't. So we are certainly on the mend. And what we're going to talk about, here we go. What we're going to talk about tonight is uh, is gold, silver. Uh, is the environment right at current to begin buying up these names? And when I say time to buy gold, it's all in gold, silver, the miners. But I'm going to put a little bit of context around the miners because I am concerned about the market. Now, I'm going to talk bullishly about the market by and large on a weekly time frame. We're going to go over the weekly charts, how we poised to close out the week. And by and large, I think that with respect to the S&P 500, we could quite very well move up higher from here. I don't know how much more upside there is short term for the Qs. I think that you're beginning to see a little bit of sector rotation out of Qs into other names. And we're going to talk about the debt ceiling. We're going to talk about the economy, and this is all going to feed into the thesis of, as to why I believe that it's time to begin building back up on gold and silver. We sold some silver several weeks ago, rightly so, but it looks as though that correction may be, with one trading day left to go in the week, it may be over. So let's say hello to folks. I shall share my screen. Hopefully my audio is good. Corey, hey, Corey. Good evening, Bob. Wow, what a market. I think we're definitely getting top heavy in the indices. Yeah, we're going to go over the weekly charts. I think that what you're seeing is a market that is being driven by and large. If you take a look at the NDX relative to advances versus decliners, there's a big. Did I save that? Did I save that? I did a chart yesterday. I don't think I saved it. I know I'm not sharing my screen. Let me see if I did save it. Hopefully so. And it'll show you. That's the NYSC. No, I didn't save it. I should have saved that. Students. Anyway, so yeah, we're looking a little bit top heavy, but I think that you're seeing a lot of stocks that are underperforming. They may just begin to perform. There are two couple of schools out there that that think that simply because you have a divergence of only a few stocks leading the stock market up higher, that ultimately the stock market is going to break. It's not bullish when this occurs, but it's not 100% of the time bearish. You could bottom out and then broaden out the rally. So it's all about, can we broaden out this rally beyond top 5 stocks in the NASDAQ 100? I'm Krug. Evening, and thank you, Franklin. Thank you. It's great to be back. Pete, Mr. Pete, welcome. All right. Small crowd tonight, but that's okay. I took a couple of weeks off, and that's the price you pay. Let me share my screen here, and we will get started. Let me get back to this. Did they update it? They did not update it. Okay. I want to talk a little bit about market valuations because there's a divergence here, right? You have fundamentals, and then you have excuse me, then you have technicals. Now the technicals look pretty good, and we're going to go over to the technicals in a little while. I'm going to go over the weekly charts, but first I want to begin with the fundamentals. How expensive is this market? It's very expensive. So Let's take a look. Schiller PE ratio, 29.59. This is inflation adjusted. So this is in real terms the valuation of the S&P 500. Talon, welcome, brother. In terms of S&P 500 price to book, we're pretty elevated. You know, the last time we were up at these levels was about a year and a half ago, and we all know what happened at that point in time. So price to book, expensive. Using the Buffett indicator, we are back. The last time I went over this Buffett indicator was a few weeks ago, and we were fairly valued. Now we're back to being overvalued and roughly 44.44% or 1.3 standard deviations beyond historical trend. So if there's a correction that to be had, there's a long way down to go from where we're at right now. If this sell-off, this correction has teeth. Price to earnings ratio, as measured by the Buffett method, we are very expensive. Here we're showing a 29.2. So very consistent with the Schiller PE ratio. And when you take a look at where we are, historically to trend, we haven't retraced back down to trend since 2011. That's a long time. The yield curve. This is not what I normally go over, but I'll read this off. This is the threes versus tens, I believe. Yeah, it is. The Treasury yield curve. This is for folks that are not familiar with what the yield curve is. The U.S. yield curve, Treasury yield curve, is currently inverted, meaning short-term interest rates are higher than long-term interest rates. This unusual occurrence, called a yield curve inversion, has historically been a very reliable indicator of an upcoming recession. Now, we've talked about this for a long while now, and it hasn't necessarily meant that you sell your stocks. It just means that get ready that there's something very, very wrong with the economy. And ultimately, this usually resolves itself with a recession and a heavy stock market correction. Since World War II, every yield curve inversion has been followed by a recession in the following 6 to 18 months. We're well into that now. And recessions are naturally correlated with decreased stock market returns. So, and that's fairly safe to say, right? Because over the past 2 years, you know, the stock market hasn't done all that much. It's been basically in consolidation. And here you could see that this spread, this is a different chart than what I would normally use. This is the 10-year Treasury versus the 3-month Treasury. And you can see that we are at historical levels here. And each area in gray, you'll see that every time we spike up, we see that gray area. That signifies recession. So obviously we don't have a recession here yet. But the last time we saw this is back in 2019, and we had that very brief recession. So this just gives you an indication of where the markets are in terms of valuation and in terms of indicators out there that are very, very concerning. But at current, the market is ignoring all of these signs. Why? It's the Federal Reserve, as it always is. Now, I want to make an argument as to why the stock market can continue up higher, even though that I've made the argument and validated it, proven it to you that the stock market is expensive. You know, how can we move up higher? Well, it's simple. It's very simple. It's called margin. And margin debt has decreased dramatically. A lot of people have come off of margin. That means that there's a lot of buying power out there. And always remember that each bull market top, or in this case, maybe a bear market rally or a cyclical bull market within a secular bear market, each one of those rallies or bull market tops is always accompanied by retail money coming in with borrowed money and speculating on the most speculative stocks in the world. We saw it 2 years ago. It didn't end well. This time around, it's not going to end well at all. And names I'm hearing about these past few days are names like very speculative names. Mara, that was up 2% today, and it looks like it's going up higher. UPST, which was pointed out to me by one of our members, that was up 9.21% today. So these very speculative growth stocks are now beginning to come to life. And this is why I said earlier that you're probably going to see a stalling on the triple Qs and money rotate into these lesser known names. So we'll go to a chart of the other 8 major averages in a moment. But let's now begin to talk a little bit about the economy. Tomorrow, I will disclose we put on or added to a short position today of the triple Qs. Why? Tomorrow is the Pimp Mac Daddy of all economic reports, and that is the non-farm payrolls. And we're going to get along with it average hourly earnings. So think about what the Federal Reserve is looking at right now in terms of a Fed rate hike for June. They're looking at wages. Wages matter to them. They want to see job losses. Job losses to the Federal Reserve is good. Why? It's because if there's more supply of workers, then it's perceived, and rightly so, that employers need not pay more to their existing employees. They could get rid of that employee, bring on another one for cheaper. So that's what the Federal Reserve wants, so that they can claim victory over inflation. Now, the other thing that I took note of going back several reports on non-farm payrolls is that ever since the Biden administration came in, this report every single time has beaten by a mile. But what do? They manipulate the front month number, meaning this report for May being released tomorrow is probably going to beat by a mile. That way, the regime gets all the play out of the news. It looks as though they're doing a good job. But when you pay closer attention to the revisions to the prior reports, which does not get the headlines, they revise those job numbers down. So tomorrow, if we get a big beat on jobs and especially on wages, that will be a problem for the equity markets because everybody's looking at the June meeting for the Federal Reserve. Do they raise interest rates? So, do they raise interest rates? I don't think so. Because yesterday, let me refresh this. Yeah, it even dropped down lower. Yesterday, at the end of business, I took a look at this chart, and this bar here implies the Federal Reserve, the expectation by the markets of as to whether or not the Federal Reserve is going to raise rates in June. Last night, this was at 75% probability, now at 18%. So usually the Federal Reserve delivers what the market is expecting. What's the market expecting? No rate hike. No rate hike. That could all change tomorrow with non-farm payrolls. Watch the wages. Watch the wages. And I'm very surprised that the markets shrugged off the very strong ADP report today. Very strong. Because remember, bad news is good news is bad news for the stock market. Now, another reason why I think that they will not raise this time around is that they're already prepping the market. They have released a statement, a June skip jumps to the 4 following latest comments. Basically, what they've said is that they're not calling a no movement in June or July a pause. They will not use that phrase because a pause implies a pause before the next cut. What they want you to believe is that they're only going to skip a meeting or two, or three, or four, or five until the next rate cut. You say tomato, I say tomato. They don't raise rates. That means that there's something wrong that the Federal Reserve is concerned about. So we know that when the Federal Reserve begins to pause and especially pivots, that's when equities begin to underperform because there's something that the market is worried about, because the Fed is worried about something that is out there. Why isn't the Federal Reserve raising rates? So that doesn't mean if they pause, equities are going to collapse. It means that they'll probably have a knee-jerk reaction higher. But if they continue to skip rate hikes and the economic story, the picture begins to deteriorate all that much more, then the markets become a lot more jittery. And they'll be looking for those rate cuts. But the damage with all of these rate hikes has not yet been felt by the market. It's not about the rate hikes per se. It's about the rate of change of the rate hikes hitting the economy. We have never, even Volcker, never raised interest rates up this far, this fast. Now, why is the stock market moving up higher right now? It's because they haven't hit the market yet. They haven't hit the economy yet. They're going to. Those first rate hikes by the Federal Reserve are now only hitting the economy. Soon, the 50 basis point rate hikes, they're going to hit a lot harder. So buckle up over the course of the next several months. We're probably going to be trying to cut rates because the economic picture is not doing well. Why else do I think that the Federal Reserve is not going to raise rates besides what we've gone over already? Here are wages. Now, these are real hourly compensation for all workers. What does that mean, real? That means adjusted for inflation. The worker is getting annihilated like we've seen no time since 1950. Now, consumer discretionary stocks look like they want to move up higher. I think that's going to be a sucker's rally because the consumer is dead. You saw prices for agriculture move up dramatically this week. So inflation, at least on the food front, is beginning to move up higher. Ex-core, meaning ex-food and energy, at the core, inflation is still sticky. Prices are not coming down. Housing not coming down yet. Home prices have begun to come down. So now let's talk about another reason why the price of gold, the price of silver should now begin to move up higher. We've talked about yields, right? We've talked about the fact that the Federal Reserve is going to pause. Inflation is still sticky. So we're moving into what you call a stagflationary environment. In a petri dish, if you can take a petri dish and if you can recreate stagflation, it's the perfect environment for gold to grow. So, and when I say gold, I'm talking gold and silver. So last night you had McCarthy. He got his deal. And he got more Democratic votes. This is a Republican House leader. And he got more Democratic votes than he did Republican votes. And you would think that by now, because it only takes one congressman to demand a vacate of his seat, and it's basically a vote of no confidence, and they can have him removed. As far as I've known so far, not one congressman has come out and said, hey, you betrayed us. So the pox in all their houses. Pardon me, my voice is starting to go already. Ginger ale helps. But be that as it may, forget about the political aspect. The outcome here is this. We spoke about this on Sunday night. The Republicans are going to say, we got you your spending cuts. No, they didn't. There are no spending cuts. What they're saying is that we've given you a 2-year spending freeze. But first, we're going to increase spending by $4 trillion. Also, We're going to freeze spending at post-COVID levels. They're not going to bring down to 2019 levels. No, 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 no. So all that emergency spending, which they don't need emergency spending for anymore, that stays. So all they've done is taken future budget increases, pulled them forward, and increased it by $4 trillion. And they have delayed now until 2026 any debate on a debt ceiling increase. So we hit the debt ceiling, no need for a debate about it. Until 2026, you get an automatic increase in the debt ceiling. You want to talk about betrayal from your leadership? I expected this from McCarthy. Not a lot of people did. I did. I didn't want him. Now you've seen what this guy is made of. So, and if they don't vacate his seat, if they don't throw him out, a pox on every single, it only takes one Republican in the House to vacate his seat, or at least to get a vote to vacate his seat. I'm looking at Matt Gaetz. I'm looking at Lauren Boebert. I know you're out there. Forget about Marjorie Taylor Greene. She's sold out. They bought her up. So she's gone now. So this is going to be inflationary. Now, remember, what causes inflation? The government spending. They're going to blame you. They're going to blame me for spending too much and causing too much demand, when in reality, it's the government that is printing the money, spending it into reality, and all they're doing is they're stealing our future. They're stealing our future. It's a tax hike, what they're doing, but they're using inflation. They're not going into Congress saying let's raise taxes so and the people will hold us accountable. No, they want to pretend that this is not inflationary, which it is, and they want to hope that you won't see what they're doing, which we're talking about right now, because you're smart enough to know inflation is because of the government. No other place but the government. So, if you have the federal government now taking up all of the capital out of the private sector, what happens? Well, you stifle growth. If you have a Federal Reserve that's killing wage growth, well, you have a consumer that's getting poorer. So you have an economy that is slowing down, and you also take a look at, while the jobless claims data hovers near 18 months high, it ignores soaring layoffs. The layoffs are not being reflected yet in the jobs data. Planned layoffs are up fourfold so far this year. January through May, 418,000. All of 2022, it was 364,000 jobs. We have already, in the first 5 months of the year, eclipsed the total number of layoffs of 2022. But according to the Federal Reserve, that's a good thing. That's their goal, as sick and perverse as it is. Why else is the Federal Reserve going to pause? I should have put this sooner. The bank bailout facility continues to hit new record highs. It had dropped down, but it's really churned back up again. So apparently these banks are still in a heap of trouble. Now, why did the banks get in trouble? Well, their risk management was horrible, yet they were the reason why they needed proper risk management is that they were forced to buy treasuries, which were only yielding 1%. So they couldn't structure out that debt and manage that risk. And that's why a lot of these banks are going under right now. And you have a Federal Reserve that can't raise rates anymore. They have to see what happens with these banks, because this is a real-time snapshot. These are these banks going over to the Federal Reserve and saying, listen, we need overnight loans. You got to help us out here. And what the Federal Reserve is doing, they're taking in the treasuries that they sold to these banks as collateral and then giving them the money so they can live to play another day. This is a problem. More economic stress. U.S. manufacturing survey signals renewed deterioration of business conditions. Again, this is all about stagflation. We're building the argument right now for gold. We know that stagflation Again, what stagflation is an inflationary environment in a low growth economy. In May, orders and prices plunge. More economic stress. Chicago PMI unexpectedly plummets, longest contraction streak since Lehman. There's another report out there from Texas, same thing. That region, their PMI, I think they reported a couple of days ago, and they're getting hammered in the Texas region, which is a boom region. We already went over this. Now, looking at the Federal Reserve's balance sheet, the balance sheet of the Federal Reserve continues to grind lower towards those March lows when the banks began to go belly up. The question is, do we take out those lows? Because technically, this is a kind of a rate hike on money. They're taking money out of the system, so this is not bond. This is if you have a regional bank, you don't really want to see this. It's making the cost of money more expensive for you. Now to gold. Central banks are buying gold at a record pace. What does that mean for inflation? Well, we already know. Inflation's here. It's sticky. Stagflationary environment. Here's the chart of central bank demand. This is the largest bar going back to 2010. We all get the picture here. The central banks know what's going on, and they're buying gold hand over fist. Now, hopefully this chart has updated. It's still on the 31st. It's updated. Good. The dollar. Now, for those not familiar with the correlation, always know your correlations when you're trading. So this is you know what? Let's just put in gold. And it's pretty much this is a weekly chart. And you can see that there's an inverse correlation between gold and the US dollar. So if they were highly correlated, you would see gold up here, but at current, you're in negative numbers. And the only reason why you ever get to a correlated relationship between the US dollar and gold is usually when there's a crisis. So we're not in crisis at current. And on the week so far, we have a bearish reversal week. This appears to be a top. One trading day left to go. So the dollar is not looking good. I'm going to go over the chart of the yen and the chart of the euro in a moment, weekly time frame, validating that there's probably more downside here because it looks as though those other currencies, which are the two major currencies relative to the US dollar, they are getting ready to make moves back up again. That means we have another lower low for the US dollar after putting it, another lower high on the US dollar, and get prepared for another lower low, or at least a test of the support level. So taking a look at gold and how it's performed so far on the week, we have a bullish reversal bar. We're back above the 20-period moving average, and we're up over 2.5% on the week. Very bullish price action. Silver weekly chart, we have broken back out. So silver looking very, very good here. And we'll probably, if we appear poised to close back above this support level, tomorrow I'll be buying back our silver position at lower prices. So members, expect an alert tomorrow. Now, let's segue over. What kind of time we have? We have a half hour. Let's segue over into this is the yield curve that we watch. And this is, I always say that the yield curve, when it's inverted and declining, you don't really have to worry too much about equities. Last year was not the case, but over the course of, 5 decades, uh, that's usually the case. When the yield curve is inverted, equities don't necessarily correct hard. It's when the yield curve steepens. And while we saw a rollover on the steepening, we have begun to hook back up. One trading day left to go in the week. This is only a weekly chart. Now, on the month, last month, we saw very bearish price action, meaning it's the steepening that matters. So as long as you see the yield curve continuing to invert, equities can move up higher. It's when the yield curve begins to steepen, that's when equities have a problem. Now, we went up today on the yield curve. Equities didn't care. That's a rarity. Can they continue that? I don't think they do. So if the yield curve continues to steepen up here, remember, at current, no new lower monthly lower low after putting in a very bearish candlestick last month. Moving on to, we talked about the US dollar earlier. I mentioned I wanted to talk about the euro. Bullish key reversal bar on the euro, one trading day left to go. If it closes stronger, if it it's going to go up higher. This is a very powerful candlestick. And when you take a look at the yen at current with one trading day left to go, a lot can happen. We are at current back above resistance. These are the two largest positions against the US dollar in the Dixie basket. This is the Dixie basket here. So it's this price relative to FXY, FXC, and a bunch of other currencies. Now, I mentioned earlier that we may be getting ready to see some sector rotation, meaning money leaves the queues, goes into perhaps the transports, perhaps the S&P 500 as a whole, and that advanced decline line begins to broaden out a little bit. You get more advancers than decliners, and that can keep the stock market moving up higher, at least as measured by the S&P 500. The Qs may stall out a bit. Now, the weekly chart of the transports, we're consolidating nicely here. On a daily time frame, we've been breaking support, recapturing support. But when you smooth out the chart using the weekly chart, which is why we do this every Thursday night, and then again on Saturday with members, is that we get a feel for, okay, we know that it appears as though we have a consolidation here and very, very strong support immediately below, and this may get resolved to the upside. The Dow Jones, I can't make as clear a case for the Dow Jones Industrial Average, but you can make the case that we're consolidating here, holding support, and that we may break out. May. No guarantees. As for the S&P 500, it's already gotten the message. It had been consolidating, much like the transports were consolidating. The S&P 500 been consolidating for several weeks. Then you got the breakout, continuation move up higher this week. We're at resistance at current. Do we break out? Do we break down? I think we break out on the S&P 500. Qs, different story here. Now, the Qs are very extended. Doesn't mean they can't move up higher, but they are very extended. I remember it was only a few weeks ago that 307 was support. Now, you're looking at what, 347 is support? That's a big move in a very, very short period of time. Let's take a look at how we did on a daily time frame. I want to take a look in particular at volume. Volume on the week is going to roll in below average. On the day today, we had broken down yesterday. Today, a nice rally up 1.16%. We saw a bit of a fade off the highs at the close, and volume was just below average. Let's go to the close, 30-minute time frame. Yeah, saw some selling into the close. Not a lot. You do saw some buyers as well in the final minutes of trade right here. Now, the two other charts I want to talk about before we go do the chart requests are the banks. Weekly chart, the banks, they're down. And they're down on appears to be weak volume. Now, taking a look at the KRE, these are the regional banks. The regional banks are continuing to get annihilated, down one spot, 2%. I don't think this is over. I do not think that this is over. There's a chart I had to point to that said, get concerned. This is it. You're going to have the 50-period moving average cross down below the 200-period moving average pretty soon. So beware of these regional banks. I want to leave this off with the semis, weekly chart, bearish reversal bar, one trading day left to go. We're holding the breakout, which we saw last week. So that is optimistic. But we are down off the highs of the week. Perhaps that'll change tomorrow. But just to give you a feel for where the semis are at, weekly time frame, let's take a look at a daily view. They had broken down yesterday, recaptured support today. A little bit toppy here on stochastics, but they recaptured support today, so a pretty good day for the semis. Volume was just shy of average, but respectable less. Let's do some chart requests. Check the members area here. First. Okay. A couple to go over. Okay. Let's get to it. I'm in this trade on Chipotle, and it's a short bet. I got into this trade due to an earnings trade I got in on, and I never wanted to short it, but I'm carrying this position, and it looks as though it's got a strong weekly close coming up, and I'm going to have to lighten up tomorrow if we appear to close out the week this strong. Let me take a look at the daily view. Yeah, outside reversal bar today. Damn it. All right. Yeah, we broke out 4-hour time frame. I'm going to have to lighten up. All right, let's go to, so one came up as 3M. Hey, TC Burton. Welcome, pal. Corey, I don't know whether to laugh or cry at UNG. Yeah, I saw Boyle today. It was pretty bad. Pretty bad. I given the economic slowdown, these energy names are not going to do well. So I'm kind of bearish on these names at current. That's honey, lemon, ginger. Okay. You got it, Dan. All right, 3M. It's just not coming up. Excuse me. It's not looking good. It remains in a full-fledged bear market. It had broken out back here the week of April the 24th. It was looking good, and it failed to hold support. It broke support at about $100 a share. Wow, 3M is down below $100 a share. Go figure. Volume on the week is low. Momentum to the downside is beginning to flatten out as measured by Stokes. But I'm not seeing a trade here. Let's do this. See how expensive the options are. You can get some fairly good premium if you wanted to sell puts here. Go out, excuse me, 45 days, 40 days. Go down to the 84.39 $85 strike. Get some good premium there. Perhaps sell a call against it as well. Open up a strangle, but it's not looking good as a buy right now. I would prefer to sell premium on this. If the shares are assigned to you, great. You got them at a discount. Daily chart. They broke down 2 days ago. Inside bar today. They're probably going to rally this back up to 93.50. Uh, I would sell premium here. I like this trade. I wouldn't necessarily want to buy 3M right now, hoping that it breaks out. I would buy the shares if it did break out and above resistance at around 95 bucks a share, a little bit more than that. But 3M's looking okay, but more so as an options trade. I like selling premium here. You're going to get fairly good premium, and that's the way I would trade it. You bet, Pete. All right, HLG. Hartford Longevity Economy ETF. What the heck is this? What is an ETF that's a play on? I wouldn't say genomics, but more so on cryotherapy and things like that. That's a heck of a name. Hartford Longevity Economy ETF. All right. Not a lot of data here. It's thinly traded, very, very thinly traded. But you take a look at a weekly chart. It's looking okay. It's broken out on the week, but you have one trading day left to go. Assuming that it holds gains here above 22.50, looks okay. Looks good. Weekly momentum looking good. Looks good. Monthly view, you're gonna have some resistance above at around 24, 25 bucks a share. So that's all I got on this one. I have a couple of others I need to go over. BITO, BITO. Avoid. Bitcoin strategy ETF. Avoid this. It's broken down below support. It's moving lower. That's a daily chart. Excuse me. Weekly chart. Not looking good. I don't see a compelling reason to be buying here. I would avoid this. Amazon, AMZN. Amazon's come a long, long way. But I think it's got more room here, up to 125 per share daily view. Week volume. Oh, look at this. Daily view. We're just shy of resistance at 122. Let's call it 123 per share on Amazon. Very long in the tooth on Stokes. I would wait for a pullback here before I got involved with Amazon or a close above this resistance level at around 125.50, 24.50. Thanks, Dan. Appreciate it, man. And looks like we're wrapping this up a little bit early tonight. That's good for my voice. I have Rivian. Daily View Rivian. This is actually looking pretty good. I did not expect to see good out of Rivian. Let's go to a monthly chart. Oh, this is a daily chart. That's why. Let's go to a monthly chart here. I haven't looked at this in a long time. Eh, Eh, not loving it. Uh, if we close above last week's highs of 15.14, I would be a lot more constructive on Rivian. It was higher on the week, but it's faded. But I do like the daily chart, though. If we get a breakout and a close above $15.15, Rivian, a buy. And with that, folks, guys, I'm going to sign off early. I'm not seeing a lot of requests come through. I do see UNG out there. I'll go over that. And I'll give my voice a break tonight. This is a daily chart of UNG. We'll come back to this. We're breaking support on a weekly time frame. I would avoid this like the plague. Volume rose today. I would have to say avoid it. I'm not seeing a compelling reason. We're not in extreme oversold levels. No real compelling reason to get involved with nat gas here, especially with a slowing economic environment. So no go. No go on nat gas. Franklin, you are welcome. TZ Burton, you are welcome. And folks, thanks for being here. Smash the like button, subscribe. I'll talk to you soon. Have a great night. Profitable trading day. Be well.